IAS2 inventory. Inventory, these are goods manufactured or purchased for reselling the normal course of the business. Inventory can be goods held for resale, it can be finished goods, it can be raw materials, or it can be partially manufactured goods. Now, cost of inventory includes all costs that are incurred in bringing inventory into its present location and condition. Now, there are two types of businesses. It can be a retail business where we buy and sell inventory, or it can be a manufacturing business where we make our own products. For a retail business, the cost of inventory includes the purchase cost, but we subtract trade discounts and rebates. For example, we are a company that is selling mobile phones. So the cost of the phone is $800, but when we negotiate with the seller, he gives us a discount of $100. Now, you might find we've been buying from that supplier for a long period of time, and because of that, he might give us a refund of maybe $50. Now that will also be subtracted, and the refund would be the rebate. So we need to add on the carriage inwards, because the definition says total cost incurred in bringing the inventory into its present location and condition. We are not going to be selling phones from UK. We have to deliver it here. So carriage inwards would be added, and non-refundable taxes. So if carriage inwards, we have to pay DHL maybe $50, a transport company. Then import duties could be $30. That will also be added. Handling cost. Now this normally applies for delicate items. So where you have to pay insurance in transit, assuming we are paying $20 for insurance in transit. And we need to also add on restoration cost. You find that before we can sell this phone, it has a damaged screen. So we have to restore the phone into its original condition before we can sell it over to our customers. So the restoration cost is also added to the cost of inventory. Maybe it is $70. And when we sum up this, we get a total of $820. So the total cost of inventory, or the total cost of this phone, was $820. Now for a manufacturing company, where we buy and where we make our own products, assuming we're a company that is making hibiscus drink. So total cost would be all costs that are incurred that are directly related to production. The first one is the material cost, then conversion costs. Now conversion costs, these are costs that are incurred in order to convert materials from one form to another form. So in that way, we need labor and we need production overheads, e.g. power. Then you find that to make this, we need machines. Maybe we bought a machine at $1,000 and it is being depreciated over 50 years. So it means we have to charge a depreciation of $20. We also need to add packaging cost. Now the total cost would be, maybe material cost is $100. Then packaging cost, conversion cost is maybe $50. And plant depreciation, we've said we are charging $20. And to pack this as well, it is also part of the inventory cost. Packing is maybe $10. Now this total would be $180. Now assuming we are making maybe 100 of these, so cost per unit would be 180 divided by 100, which would be $1.8. So the total cost of each of these is $1.8. Now take note of the following. Following costs should not be included in the cost of inventory. Instead, they are expensed in the statement of profit or loss. The first one is non-production costs. A manufacturing company, we've said cost includes all that costs that are directly related to production. Now, what are production costs? Production costs, these are costs that must be incurred in order for production to take place. So this is a must for production to take place. For example, we need materials, we need labor, and we need production overheads, e.g. power. If we don't have those, we can't produce. Non-production costs, you see, these are costs that are not important for production. They are not important for production, but they must be incurred in order for production to take place. For example, we need administrators, we need managers, but even if we don't have managers, we can still produce. Then after production, we need to sell and distribute the products. Then we have abnormal costs, for example, wastage and idle time. For example, to produce this, maybe it is 100 grams, but when packing, we end up losing 10 grams. So you see, the total would have been 110, but we lost 10 grams, meaning the balance is 100. So this inventory, it has 100 grams, not 120. And finally, costs incurred when inventory is ready to be sold. For example, storage costs. You see, it is after producing, we need to store these before they can be distributed to the sellers. But take note of this, storage cost can only be included unless if it is part of the production process. For example, in production of whiskey, it has to mature. So after producing it, we might have to keep it for some days. Then it matures before we can sell it over to our customers. So that cost will also be included as part of the cost. Valuation of inventory. Now, according to IAS 2, inventory should be valued at the lower of cost and net realizable value. Now, the standard says cost should be the original cost, not current cost or replacement cost. Now, assuming we are buying a phone and the original cost is maybe $820, but so this phone, we bought it at $820, but if we are to buy a new one, the current cost is maybe $600. So the standard says cost is original cost, not the current or replacement cost. So this phone we are talking about, we originally purchased it at $820. Now, what if we want to sell off this phone and the best buyer we have is giving us maybe $500? So selling price is $500, but the buyer is saying before he buys the phone should be in a good condition. Now you might find that the phone has a broken screen, so we have to replace the screen, and the repair cost is maybe, or replacement cost is maybe $50, and the person buying the phone is far from us, so we have to transport the phone to where he is, and the transport cost is $10. So you see, before we get the 500, we have to put in $600. Now this is what we call the selling costs incurred before selling. So the net amount we are actually getting is $440. So this is the net realizable value, and it is selling price minus the selling costs. So the standard says we should be valuing at the lower of the two. So we should value at the net realizable value for this illustration. Now, for a company that is making its own products, it is selling price minus costs to complete to complete the production. For example, we want to sell off this, but we have to put on the labor as well, so that cost of the labor will also be included as a selling cost. Now, choosing the lower of constant net realizable value is application of the prudence concept, and prudence concept states that assets should not be overstated and liabilities shouldn't be understated. So we are going to try out a question. So this is the example, and the exam technique is you always start by reading the question. So they want you to calculate the total cost of inventory at the end of the period. Now a company has 3 products, A, B, C. So these are the products: product A, product B, and product C. Now this is the cost. For A it is 100, it is 10, it is 12, and 6. Then we need to find the net realizable value, and we said net realizable value is selling price minus selling costs. Now the estimated final selling price they are giving us is 15, but before we get 15 we have to put in $3. So net realizable value will be 15 minus 3, which gives us $12. And for B it is 16 minus 5, which gives us $11. And finally for C it is 11 minus 4, which gives us $7. Now the valuation, the standard says we should value at the lower of the two. So the lower for product A, it is the cost, which is 10. For B it is net realizable value 11, and for C it is cost, which is 6. So the total value of inventory would be, for A, each unit is valued at 10, but in total we have 100 units. And for B, each unit is valued at 11, and in total we have 200 units. And finally for C, each unit should be valued at 6, and in total we have 150 units. So when we calculate, the total value of inventory is $4,100. So pause me and try out this next question, but the answer is D. Try out this other question, and the answer is C. Pause and try this labeled number 2, and the answer is A. And finally, you're going to pause and you try this one labeled number 3, and the answer is D. I'm doing for you number 5. Exam technique. Read the question first. They want you to calculate the value of closing inventory to be recorded in the statement of financial position according to IAS 2. Now a company has 2 products, P and Q. It buys and sells them. So these are the products, product P and product Q. Now we need to find out what is the total cost for product P and total cost for product Q. Now total cost for P would be the purchase cost, then plus the $20 delivery from the supplier, then delivery to customers would be a selling cost, card sales packaging. So we need to pack the product before we can sell it. That would be part of the cost. Then selling price, we shall need it to calculate the net realizable value. So total cost for product P is going to be $100 plus $20 plus $15, giving us 135. And for product Q, it is 200 plus $30, then plus the $18, giving us 240. $48. Then what is net realizable value? We said it is selling price minus selling cost. So for product P, it is going to be product P, it is 150 minus the $22. So we get 128. Then for product Q, it is 300 minus 40, we get $260. So what is the valuation? So we said, how should we value item P and item Q? Valuation is at the lower of cost and net realizable value. So for P, we are going to value at 128, and for Q, we are going to value at the lower, which is 248. So this is the total valuation, 128 plus 248. And when we add up this, we get $376. So this would be the answer, $376. So we are trying out number 6, and they want you to find the total value of inventory on 31st May 2007. So company buys and restores items, then after it sells them over to customers. Now these are the 3 items: the jewelry, we have the necklace, we have the bracelet, and we have the pendant. Now what is the total cost of the necklace? Total cost would include purchase cost, and we said we should also add the restoration cost. So total is going to be 18. Then for the bracelet, it is 31 plus 5, we get 35. And finally for the pendant, it would be 45 plus 2000, we get 47. Now what is the net realizable value? And net realizable value, we said it is selling price minus selling cost. So expected selling price for the necklace is 25,000, but before we can sell it, we need to put in 2,000. So the net realizable value would be 25 minus 2,000, we get 23. Then for the bracelet, it will be 38 minus 3, we get 35. And finally for the pendant, it is 53 minus 1,000, we get 52. So what is the valuation? The standard says we should value at the lower of cost and net realizable value. So for the necklace, the lower is 18. For the bracelet, the lower is for the bracelet, when we add the total cost, it is 36, not 35. So when we value at the lower, which is 35. And finally for the pendant, it will be valued at 47. And when we sum up this, we get a total cost of 100,000. So the correct answer should be C. So for the next question, I'm giving you an illustration to help you understand on how to do it. Now we are counting inventory, and you know counting takes place at the end of the year. So when we count at the end of the year, the total value of inventory is 120,000. But included in that 120, there are 2 items, item A and item B. Now item A has a cost of 10,000, and the net realizable value is maybe 8,000. For item B, let me use the same figure. Item B has a cost of 10,000, but net realizable value is 13,000. Now these two items A and B were included in the 120 at cost. So they want you to calculate the revised closing inventory according to IAS number 2. Now what do we do? You see, what would be the valuation for item A? Item A should be valued at the lower, which is net realizable value, and item B should be valued at the lower, which is cost. But what did they do? They included both items at cost. So for A, we need to adjust because it should be valued at 8, not 10. And for B, there will be no adjustment because they already did the right thing. So what is the revised inventory? So when those items were included, the total value is 120. But we've seen item A should be included at the lower, which is cost, the lower, which is net realizable value. So we remove the cost, and if we remove the cost, we get what was the value before we included item A. Then we include what it should be. It should have been valued at 8. Then for item B, there is no adjustment because they already did the right thing. They valued at the lower, which was the cost. So the revised value of inventory is going to be, so when we work out, it is 118. So the revised value would be 118. So we are going to try a question on this. Read question 7. Don't forget the exam technique. You start by reading the question. What should be the value of inventory according to IAS 2 after considering the above items? So we read the question. Closing inventory at cost on 31st January 2027 was 284,700. But the following items were included in at cost. So two items were included in 284 at cost. These are the items. We have the coats and we have the skirts. So what is the total cost of the coats? You read the data. There were 400 coats, each costing $80. When you multiply, you get 32,000. So the cost was 32 for the coats, and they are normally sold at $150 each, but owing to a defect in manufacture, so during the manufacturing process, they were damaged, and they can all be sold at reporting date at 50% of their normal selling price. So we can only sell them at a selling price of 150 times 50%, so we get $75. But the question is adding on that selling expenses amounted to 5% of the proceeds. So 5% of what we are getting. It means the net realizable value is 75 minus 75 times 5%. If we work out, we get we get 71.25. So that is the net realizable value per coat. But in total, there were 400 coats, meaning the total is 200. Net realizable value is 285. Then we look at item 2, the skirts. 800 skirts, each costing $20. So the total cost would be 16,000, and they were found to be defective, and repair work had to be done in Feb at $5 per skirt. The selling expenses for the entire batch was $800, and they were sold at $28. So what is the net realizable value? Now net realizable value, we said it is selling price minus selling cost. So total selling price is $28 times 800 minus the selling costs incurred before we sell. So it is 800 times the repair cost of 5, that is the repair work, and they had to be transported, and the transport was 800. So plus the $800, and when we work out this, we get $17,600. So what should be the valuation? When we are valuing, we should value at the lower of cost and net realizable value. So for the costs, the lower is 28, and for the skirts, the lower is 16. So this is 28,500 and this is 16. But what did they do? They included both items in this figure at cost, and the question wants you to calculate the closing inventory after considering those two items. So these two items were already included here at cost. So for the costs, they included 32, but they should have included 28,500. So what do? You first remove the 32, and if you remove the 32, you get what was the figure before they included the costs. Then you include the right figure, which is 28,500. Then for the skirts, they already did the right thing because the question says the items were already included in at cost. So for the skirts, there is no adjustment. So the total value would be 281,200. So that is the valuation after adjusting for the above two items. So try out this other next question and make sure you get C as the answer. You try number 5. Make sure you get A as the answer. Then here comes question labeled 8. So for question 8, be careful. The data is similar to what we've been doing, but here the trick is this. So make sure you don't bring your cram work. The question has said closing inventory was this, but excluding what we are doing before, the values were included. So this one means it is before including. So it is before including. So when you're working out, you should start with this figure. Then you look at item 1. What is cost? What is net realizable value? Then you include what it should be. Item 2, you do the same. Then number 9. So number 9, you're supposed to calculate cost of sales. And we say, okay, cost of sales is given as opening inventory plus purchases minus closing inventory. Now you're given opening inventory, purchases, and closing. But they have told you closing has a problem. So closing inventory includes the following damaged items. So tables were costing 500, and because they were damaged, they can be sold for 200 after incurring a cost of $50. So for the tables, what is the cost? Cost is 500 and the net realizable value is 150. Then for the 4 chairs, there are 4 chairs. What is the total cost? It is 4 times 100, which gives us 400. and each was also damaged by fire, and they can only be sold at $20. So how should we value? For the tables, they should be valued at 150, and for the chairs, they should be valued at a total of $80. So 20 was for each, so in total it is $80. So the question says these items were included in closing inventory. So we need to make adjustments. Okay, now total closing was 442,800. So we adjust for the tables, we remove what shouldn't be there, and we put what should be there, which is the net realizable value. Then for the 4 chairs, they were included in at cost, but they should be valued at net realizable value, which is 80. So when we work out, we get a revised closing inventory of, so the revised closing inventory is 42,130. So our cost of sales would be opening inventory, which is 45,678, plus purchases 98, minus closing, which is 42,130. And if you work out, you should get 101,548 as your cost of sales. Adjusting for transactions that occur between inventory count and the end of reporting date. Now you know what happens in businesses. They normally wish to count the closing inventory at the end of the day. Maybe this is 1st Jan and this is 31st December, maybe 20x3. So we want to count and see what is the closing inventory on this date. But you know what happens? Counting doesn't take place in one day. We might find we are counting up to 4th Jan next year, 20x4. And when we count on 4th Jan 20x4, the total value of closing we have is 100,000. But in between 31st December and 4th Jan, the business isn't just static. There are transactions that take place. For example, you might find that we made a sale of maybe 10,000. We made a purchase of maybe 8. We did sales returns. Customers returned goods to us, goods worth 500. And we did maybe a purchase return. We also returned to the supplier goods worth 300. So the question is, what is the inventory on this date, on 31st December? So how do we get inventory on 31st December? So we use this formula: closing inventory is equal to opening inventory plus what increases minus what reduces. Now in this case, what is our closing? It is what we have on 4th Jan next year. So on 4th Jan, we have 100 is equal to what we had at the start. Then we look at the transactions. If we make a sale, what happens? It reduces the inventory. So we subtract 10,000. If we buy more goods, it is added on. So we add 8,000. Sales returns, customers are returning goods back to us. So that one increases what we have. Then purchase returns, we are returning to the supplier. So it is 300. And when we work out our X, which is the closing on 31st December 20x3, it would be, so the answer we get is 101,800. So this would be the value of the closing inventory, or the inventory that was there on 31st December 20x3. So pause me and try out this question and see if you can get this answer. You also try out this and see if you can get this. So you first pause and try out. The first one is here, then the second one is down. So we look at the impact of overstating or understating closing or opening inventory on profit and net assets. Now what you need is this. How do we calculate profit? Profit is always calculated as the sales revenue minus the cost of sales. And how do we calculate cost of sales? Cost of sales is opening inventory plus purchases minus closing inventory. So I'm giving you figures as an illustration, assuming opening inventory is 1,000 plus purchases 10,000 minus closing, which is 2,000. So when we work out, our cost of sales would be, so cost of sales would be 9. Then assuming the sales were for 15, so when we subtract cost of sales of 9,000, we get a profit of 6,000. Now this is the mistake that we are doing. So assuming by mistake we overstate closing inventory. So all these figures are the same, but instead we are subtracting 3,000. So when closing is overstated, what happens? Our cost of sales would be 8,000. And what happens to the profit? It will be 15 minus 8,000. We get, so the answer we get is 7,000. Now what do you notice? If closing is overstated, what happens to the cost of sales? You're subtracting a big figure, so cost of sales would be understated. And if cost of sales is understated, it means you're subtracting a small figure, profit would be overstated. Now you can't cram this, just understand it the way it is. Then if it is closing, that if closing was instead understated, what would happen? It means you're subtracting a small figure, and if you subtract a small figure, cost of sales would be a big figure, and if cost of sales is a big figure, profit is going to be a small figure. Finally, if it is opening, what would be the impact? If opening is overstated, it means cost of sales would be overstated. And if cost of sales is big, it means profit would be understated. So just understand, you can't cram. So we are trying out this question. Exam technique, you start by reading the question. So they want you to calculate the net profit, what the net profit should have been. So I think they made mistakes. They want you to calculate the new profit. So a company reported a profit of 60,000 for the year. Then later they discovered that inventory on this date was undervalued by this. So at the start of the year, opening inventory was undervalued. And at the end of the year, inventory was overvalued. So our profit was 60,000. Then we said, if opening is understated, what happens to the profit? You see they are saying on 1st January, opening inventory was understated. So if opening is understated, cost of sales would be overstated. And if cost of sales is overstated, profit would be understated. So it means this profit is understated. So what do we need to do? We need to subtract the understatement, which is 6,000. Then the next one is closing inventory was overvalued. You see, if closing is overvalued, okay. So I want to give you a better alternative, assuming the profit was X. So what did we do? The question has said opening was understated by this. So you see, we said if opening is understated, cost of sales will also be understated. And if cost of sales is understated, then the profit would be overstated. It means to that profit we added 6,000. We overstated it. Then we do closing inventory. If closing inventory is undervalued by 9, if closing is overvalued, so if closing is overstated, then it means cost of sales would be understated, and if cost of sales is understated, then profit would be overstated. So it means our profit was overstated by 9,000. And finally, the answer we get is 60. So when we work out, our X is 60 minus 6 plus 9, which gives us 45,000. So the answer is A. So finally, we look at inventory valuation methods. Now there are 4 ways of valuing inventory. We can use the FIFO method. We can use LIFO method. We can use the weighted average. Weighted average method, or what we call FFA. And finally, we can use the we can use the periodic average. Periodic weighted average. Now for weighted average, there are 2. We have the continuous and the periodic. So if the question doesn't, so we start by looking at FIFO and LIFO. So FIFO is this. We are selling perishable items, maybe in a supermarket. So these are tomatoes. And this first batch contains 100. This one contains 150. This one contains maybe 180. So ladies come in, because it is normal ladies, and she wants a total of 150. Now these tomatoes came in at different dates. This one came in on the 1st day of the month, maybe on 4th of the month, and this came in on 10th of the month. So if you're the one selling, remember you're selling perishable items. Where do you get from? You get, she wants 150, so you first give out 100, then you pick the 50 from the batch that came in on 4th. So you see the method is what came in first. So it is first in, first out method. What came in first is what we give out first, e.g. perishable items. So you need the examples to help you remember. So if items are perishable, what would you prefer? You prefer to sell out what came in first before they perish. Now the second illustration is about LIFO method. So you know we are selling charcoal, and these are bags of charcoal or sacks of charcoal being packed. You know how charcoal is packed. Now this is the entrance, and the lady still has come in to buy some charcoal, maybe 2 bags of charcoal. Charcoal they use for cooking. Now this first batch here might have come in on the first day of the month. This is maybe 4th, and the last one on 10th. So where do we get the 2 sacks from? You see, these are not perishable items. So where do we get the 2 bags from? We don't first remove all the bags. So we get from the most recent. So we get the 2 bags from here. So this method is called LIFO method. And LIFO means the last in is the first out. So what has come in last would be the first to be given out. So we are going to look at an example. Now this is the question, and they want you to calculate the value of issues and value of closing using FIFO method, using continuous, and using periodic average. Now I have to make this clear that LIFO method is not accepted in financial accounting. LIFO is not accepted in financial accounting. Okay, now I'm just going to do a copy paste of the question. So at the start of the month, we have 100 units. So allow me to just insert it here. So at the start of the month, 1st May, we have opening, and the opening inventory we have is 100 units, and these 100 units are valued at $2.00 per unit. So I'm going to copy and paste this same data down here. So at the start, we have opening inventory, and it is 100 units valued at $2 per unit. Then we purchased. How many units were purchased? We bought 400 units, and these 400 units were bought at $2.1 per unit. So purchase is the same as receipt. Then next we sold out, or we issued 200 units. The next one is we made a purchase and we bought 300 units at 2.12 per unit. Then we sold out 400 units. We purchased 100 units at 2.4, and finally we sold out 100 units. So what is the value of closing inventory? How many units are left? So we had 100, we bought 400, so that would be 500. We sold 200, so balance is 300. We added 300, 600, we sold 400, balance is 200. We bought in 100 and we sold 100, so meaning closing inventory would be 200 units. The question wanted us to calculate the value of issues and closing inventory using FIFO method, continuous and periodic. Now I'm giving you the working. It is simple. It is this. For FIFO method, or even LIFO, but LIFO is not accepted in financial accounting. So for FIFO method, the working is simply this. You just look at the sales, or in some questions they call them issues. That is the working. Then for weighted average, let me give it to you as well. So for weighted average, you just look at the opposite, which is purchases or receipts. And whenever we purchase inventory, whenever you purchase or receive inventory, you calculate a new cost per unit. Now per means you divide, so cost per unit would be, total cost divided by total units. We shall look at that. So we start with our FIFO method. Now all you need is just the meaning. FIFO means what came in first is what we give out first. So I'm putting the working in red, FIFO method, and FIFO means what came in first is what you give out first. So this is FIFO. We say the working is simple, you just look at the sales or issues. So which one is the first sale or issue? We are selling out 200. So where will it come from? Remember, these are perishable items. What came in first is what we give out first. So we first give out 100 from the opening, but the customer wanted 200. So the 100 will come from the 400. So this 200 is finished. We look at the next one. We want to give out a total of 400. But these are perishable items. What came in first is what we give out first. So we get 100 from 300 from here, but the customer wanted 400. So the 100 will come from this 300 that we had purchased. And the final sale is we are selling out 100. Where will it come from? These are perishable items. What came in first is what we give out first. So this 100 will come from the balance here of 200. So if you want the value of what we've sold or issues, so the value of issues would be, we've given out 100 and it had a value of $2. Then plus we've given out a total of 400 and it was costing 2.1. And finally we've given out a total of 200 and it was costing 2.12. So the total value is, 1464. Then if they want the value of closing is what is left. So here we had a total of 300, but we've only given out 200. So we have a balance of 100 at 2.12. Then plus this last purchase, we've not touched it. It is 100 times 2.4. So the total is going to be, the total is 452. So that is FIFO method. Next, we are going to look at weighted average. So I'm going to clean off this and we do weighted average. So it is still copy paste of the question, but for weighted average, we said whenever you purchase inventory, you calculate a new cost per unit, and cost per unit is total cost divided by total units. So when are we receiving or purchasing first? At this point here. So what is cost per unit at this level? It would be 400 times 2.1 divided by 400 plus. So it is total cost divided by total units. So it is 100 times 2 divided by 100. And if we work out that, you should get 2.08. Now be careful on that, because from experience, some people work it out as this: 400 times 2.1 divided by 400, then plus 100 times 2 divided by 100. These two are not the same, so it is the other one, it is not this. So be careful when working it out. The answer is 2.08. Okay, then we look at the second one. Because we said we are just looking at the purchases. Every time we purchase, we calculate a new cost per unit. We've again purchased 300 units at 2.12. So what is cost per unit? It is total cost. So it is 300 times 2.12 divide by the 300 plus what we don't know. Now this is where the problem would be. So be careful. Listen and understand this. The question is simple. The trick is simple. So before we got this 300, how many units were left up? How many units were left up? So at the start we had 100. We bought 400, making it 500, but we've sold 200. So the balance is 300. So before we received this 300, we had 300 left. And those 300 would be valued at the latest cost per unit, which is 2.08. So divide by the corresponding units, 300. Now if we work out this, the answer we get is 2.1. So finally, you can first pause me and you try and calculate the last cost per unit. Okay, but it is this. It is 100 times 2.4. So you start with what you've received. But before you got this 100, how many units were left up there? So if you work out how many units were left, it would be 200, just the units, then times the last cost per unit, which is 2.1, divide by the corresponding units, 200. And if you work out that, you get 2.2. Now me, I first pause, I work out, I put the 2.2. Okay. Now the question is finished. So if they want the value of issues or value of sales, this 200 would be sold at, it had a cost of 2.08. This 400 was valued at the latest average, and this 100 was valued at the latest average. So if we want value of issues, value of what we've given out 200, but it had a value of 2.08, then plus we've given out 400 and it had a value of 2.1, and finally 100 and it has 2.2. So the total is 1476. Finally, if they want the value of closing, now closing is what is left. For weighted average, closing is the final 200. So this last 200 would be valued at the last cost per unit, which is 2.2. And if you work out, you get 440. So we look at the last method, which is periodic average. Now this is the easiest. The working is simply this. You just ignore the sales or the issues as if they were not given in the question. So you ignore the sales or issues as if they were not given, and you calculate the average for the rest. So it would be total cost divided by total units. It is going to be 100 times 2 divided by 100 plus you received 400 times 2.1 divide by 400 plus you bought 300 at 2.12 divide by 300, then plus the last one, which is 100 times 2.4 divide by 100. So all you need to do is just to ignore the sales. You calculate the average for the period, average for the entire period. And if we work out, the average is, so the average for the entire period is 2.129 if it is rounded. So the topic is finished, but we are going to look at a few tricks under FIFO and LIFO. So the first one is, the question can ask you that if prices are increasing, or they tell you that in times of inflation, which method gives a high value of closing? So prices are increasing or in times of inflation. So in times of inflation, which method gives a high value of? Our aim is to find high value of closing. High value of closing inventory. Is it FIFO method, or it is the weighted average, which we sometimes call ACCA? Now you just need to know the meaning of FIFO and weighted average. FIFO, we said first in, first out. So if prices are increasing, like you see in this question, there were $2, 2.1, 2.12, 2.4. Prices are increasing. So what does it mean? It is inflation. And for FIFO method, first in, first out. It means with FIFO method, we first sold the cheap items. So meaning at the end, closing inventory would be having a high value. So it means for FIFO, closing is going to be a big figure. Closing is high. Then we go back to what we did first. If closing is high, then what happens to cost of sales? We said cost of sales is opening inventory plus purchases minus closing inventory. So if closing is a big figure, it means cost of sales would be a small figure. And if cost of sales is a small figure, then it means our profit would be a big figure. Because we are subtracting a small figure, so profit would be high. So if there is inflation with FIFO method, closing is going to be a big figure, cost of sales would be a small figure, and profit would be a big figure compared to weighted average. Now the second one, they can ask you to calculate maybe profit. Calculate profit. So I'm not going to do the entire question. I'm just going to stop at the sale of 200 units. So I'm doing up to this level here, assuming they tell you that these 200 units were sold at $2.5. Calculate profit using FIFO method. So remember what we said for FIFO, first in, first out. So for FIFO, we are giving out 200, but where do they come from? It comes from here and here. So how do we calculate profit? Profit is total sales minus the total cost. So what would be the total sales? We are selling a total of 200 units, but at 2.5. But what is the cost of those 200 units? This 100 was costing $2, and the next 100 was costing $2.1. So when we work out, we get a profit of $90 using FIFO method. Then we are calculating profit again, but using the weighted average method. So for weighted average method, don't forget, remember here we had 2.08 as the average. So we are selling 200 units at 2.5, but their average cost was 2.08. So profit is going to be total sales. So we are selling 200 at 2.5, but these 200 units we are costing 2.08. So when we work out, profit would be $84. So it is simple. All you need to know is how to value. So we stop there for today.